Well, hello everyone, and welcome to the latest edition of Conversations with a Pro Trader. I'm your host, Greta Wall, and with me again this week is Derrick Oldensmith, Senior Trader at T3 Trading Group and the leader of T3 Live's virtual trading floor. Hi, Derrick. Thanks so much for joining me on today's event.
It's awesome to be back. I've really been enjoying that you've been doing this weekly now.
Yeah, I'm loving it. All right, so we're going to start off for those who have not been here before and those who have been here before. Our first question every single week for our traders is give me a grade of your trading week so far. So, Derrick, what do you give it? A B, a C minus, a D? What do you got?
So I think the last two times you had me on, I gave myself a solid A, and I've
Mm-hmm.
been trading really great, honestly, for the entire calendar year until yesterday. Yesterday, I think, was the worst I've traded this entire year. So if I want to be, super hard on myself and do the opposite of the last couple of conversations with the pro trader that I've been on, I'd give myself like a D or an F or some
Wow.
pretty low grade. I was really unhappy with how I traded yesterday. It was probably the worst I've traded all year, but I've been trading great all year outside of that. So
Okay, so then my follow-up question there is what made yesterday such a bad day?
sure. So I just didn't do a good enough of a job following my game plan, which is really what it comes down to in this business. And I kind of violated some of my trading rules, which does not lead to consistent profitability. In
Mm-hmm.
yesterday's morning meeting, I spent 20 minutes talking to the team about how we need to be prepared for the market range to break this week.
Mm-hmm.
So we got through OPEX last week. The market loosened up a little bit. We've got all the earnings reports that are coming out this week. We've been in this extremely tight range for the market, for the S&P, especially the Nasdaq, and for the Russell for the entire month of April. This has been the tightest range that the market's been in, I think, since like 2020.
Mm-hmm.
So extremely tight daily chart range. And the way that markets work is they work in periods of expansion and consolidation over time. So when you're in a really tight consolidation period like we've been in, especially as you're starting to come into a bunch of catalyst type events between earnings, economic numbers that are going to be coming out, the Fed coming up in the beginning of May, you're starting to get set up for a break. And yesterday morning in the morning meeting, I was like, hey, everyone, on Friday and yesterday, I think I was lulled a little bit into a false sense of security because this market's been so tight for so long. Now we're
Mm-hmm.
coming into to earnings. We need to be prepared for this market to break the tight range that it's been in. And I said it's a coin toss, basically, like a 50% chance or maybe a slightly higher probability that we break up versus breaking down. But basically,
Mm-hmm.
it's a coin toss. I was like, everyone know your key levels for the S&P, for the Nasdaq, for the Russell. And if we start to break them, then you need to look for follow through in the market. And then what happened? Well, that's exactly what happened. The market broke down very hard
Yeah.
yesterday. It started with the Russell. The
Mm-hmm.
IWM broke key support of its range pretty much right at the open. The S&P did it, shortly after, maybe a little bit after 10 o'clock in the morning. And then the NASDAQ tried to hold up the longest, and then that eventually broke down as well.
Yeah.
So I gave this entire meeting for about 20 minutes about how we need to be prepared for the market to break its range. We need to be able to take advantage of it, know your key levels, be prepared to, in this case, short through these key levels. And
Mm-hmm.
then what actually happens, the market opens up. I find myself in a complete and utter battle with Alibaba from a trading
Mm-hmm.
perspective, which turned into a 2-day trade for me. I liquidated the position today. I was able to make a little bit of P&L back, but I got into
Mm-hmm.
a complete and utter battle with this Alibaba, like a war like I haven't gotten in a while, which is really kind of contrary to my edge in trading, getting
Mm-hmm.
involved in kind of these big battles with these stocks and just trading the absolute heck out of it, trying to get the follow through that I'm looking for, kind of based on a thesis for it. And here, at the end of the day yesterday, I'm just looking at my trading and I'm like, what did you do? I ended up taking, being down at the end of the day yesterday, maybe my like second biggest day trading loss of the year in the name.
Mm-hmm.
And I'm like, you spent the entire day battling this Alibaba just to take a loss in it. When in the morning meeting, you gave a 20-minute lecture about how we need to be prepared for the market to break because it could lead to trend and follow through and continuation. And not only did I not make the money on the short side by, following the game plan that I had prepared for myself, but I ended up, losing money by battling the stock. So it's just a poor job. I've been in this business for too long to make those mistakes. I like to be really hard on myself, honestly, also when I make mistakes, because it reinforces the fact that I can't do those improper things anymore. But I'm not a perfect trader. I work really, really hard to minimize the mistakes that I make. It still happens every once in a while. And that's what happened. I kind of continued that battle a little bit today. I made a little bit of P&L back, but then I liquidated the position in the close. It just didn't want to take the overnight risk on an additional day on a position that I probably don't need to begin with. So not great.
So listening to all of that, just a good takeaway for me, for even for novice traders, is, you looked back on the day, you looked at what you did wrong, you reviewed your trade, and you figured out where the problem was, and you're not, you want to learn from that. You don't want to make that mistake again, and you didn't continue to make that mistake in today's session. For everyone that's joining us, if you haven't been here before, this is a Q&A session. So first half will be kind of me talking with Derrick about the current news that's happening, that's impacting the stock market, whether that be earnings, the Fed, etc. And then the second half, I will get to all of the audience questions. So the live chat is open for everyone who wants to ask Derrick any questions, whether that be a question you have that's totally unrelated to our conversation, or you hear something that he says and you want to hear more about that. So the live chat is open for everyone to go ahead and start submitting those questions. And then in the second half, I promise I will get to every single one that is asked. So go ahead and start submitting those. Okay, Derrick, so this is a huge earnings week. This is the biggest earnings week for first quarter earnings. You kind of already touched on what your approach to this week was overall. And you mentioned yesterday the big gap down in the market, and that was prompted by those bank concerns, particularly from First Republic after First Republic's earnings, came in the morning. Worries about the banking system came right back yesterday. The bank reported a steeper than expected drop in its deposits in the first quarter. The balance sheet looks even worse if you see, when you look at the major increase in loans last quarter with that major increase in, or major drop in deposits, balance sheet is not looking good. So give me your thoughts on First Republic and the broader banking system as we stand right now.
Sure. So First Republic, just obviously further continuation of the contagion that we've seen, starting with the SVB blow up. I think Warren Buffett did an interview a few weeks ago where he was talking about how you should expect some more banks to go. And especially, I think there's also some current concerns out there about what the commercial real estate space might be looking like and how it can affect some of these banks as well. But yeah, FRC, reported earnings yesterday. The company's got some real problems. They've got some real problems with interest from all the loans that they've taken on. And, when I look at the bank as far as the assets that they have, I think I'm, and I felt this way about SVB also. I think I'm looking at a bank that has the ability to be sound if they are able to get, short-term liquidity to be able to get through this, and if all the depositors don't run for the hills. But the problem now, I think, for First Republic Bank is who's going to want to do business with this bank anymore? If you didn't run away from that bank, as if you do business with them after the initial situation with SVB and First Republic was kind of all over the news, are you really still staying even after this now, the last couple of days? Aren't you scared? Aren't you concerned? Or how about this? As far as new business goes, imagine, Greta, tomorrow you get a cold call and the person on the other line goes, "Hey, this is so-and-so from First Republic Bank. I'm a financial advisor here. I'd like to have a conversation with you about your finances and how you could work with us so that I can improve your current financial situation." I don't know about you, but if someone calls me who's a representative of First Republic Bank, I'll click, no, thank you.
Yeah, no, thank you.
So you got a big problem here with, who's going to want to continue to do business with this bank going forward. It's almost like a branding issue in a lot of ways, where if people aren't continuing to take flight over the course of these next couple of days, like they are, then maybe the balance sheet, if they can get some liquidity injections, can be fine for it to be a going concern. But it's not looking good. So I think that the best situation here is someone coming in and buying the bank. I think that they've got enough assets that it could be attractive for another bank to come in and buy them. Will that happen or not? Will they wait for the stock to try to drop to like $1 so they can get a fire sale on what those assets actually look like before coming in to buy the bank? I think that that's what makes the most sense, because you can't have First Republic Bank as a going concern really be able to continue. I just don't think people are going to want to do business with them. But if all of a sudden it's the exact same bank, but you give it a completely different name and they get more liquidity because they got bought out by somebody, then all of a sudden, Greta, if I'm calling you and I'm saying, hey, this is so-and-so from, JP Morgan's financial advisory, and you don't realize that I was, just at First Republic Bank as a financial advisor there, but I got bought out by JP Morgan, all of a sudden you're maybe more interested in having that conversation. So we'll see how it plays out. I still think that this is very specific to some of these regionals. This is what I've been saying from the beginning. It's what I said the last time you had me on the show. I think that if this causes the big banks to decline in price, that it creates buying opportunities. I mean, look at JP Morgan, look at Bank of America, look at the earnings reports from those banks. The JP Morgan earnings report was just absolutely stellar. And they're just going to continue to become bigger and better and stronger as a result of this. But being involved in some of these smaller regionals is dangerous. So I'm staying away from them. But for disclosure purposes, and I know you had my position disclosure up earlier, I've got a position in JP Morgan that I re-entered today after liquidating into the big upside move on earnings. I started to nibble back in on the pullback today. I did the exact same thing with Bank of America. I got out pre-market when Bank of America reported into the big pop. I just started to build back in a small way yesterday into the dip. So I really like those big banks, but the regionals are scary, and maybe there's even others that end up having to go under. We'll see how it plays out.
Yeah, your positions disclosure is up this whole time. Everyone can see what you're currently holding as you're talking. So
Gotcha.
Just transparency there for everyone. All right, so we'll go through the big tech earnings in order. Lots of big tech earnings this week. So we'll start with Microsoft and Google. We got both of those results after the close yesterday. Both beats from both companies. Google's cloud segment turning a profit for the first time ever. So what was your strategy heading into those reports? And then how did you or did you not play the reaction for those stocks today?
Sure. So I'm a big fan of Microsoft, even though I don't have a position in them. They're probably my favorite company that exists in the S&P. Love the CEO. I love how he created this huge turnaround for the companies when he took over from Steve Ballmer. I ended up not trading Microsoft. I was trading it a lot. Like last week, I was involved in it. I made some profits in it, but I decided just to pull back on the position after I liquidated it and not get back involved into the report, because I wanted to see how the report played out. I did hold some Google into earnings, which I have also kind of been in for a while and have some decent pricing on. So I felt I was in a win-win situation with my Google position, held it into earnings, which, by the way, holding stock into earnings, especially if you do it with equity. I know you had Dan Darrow on last week talking about how he uses options for event-driven trades. Holding equity into an earnings event is 100% gambling. You have no idea what that company is going to report. And even if you knew what the company was going to report, you do not know how the market is going to react to it. You see companies, every single earnings report, they beat across the board and then they sell off, or they miss across the board and then they get bought up. You never know what they're going to report or what the reaction is to it. So holding Google into earnings yesterday is a gamble, but I like to occasionally do those gambles if I'm approaching it from a win-win situation. If I've got a really good price in the stock, if I'm well in the money in it, I'll sometimes hold it. If the thing continues, great, I'll make even more money on the position. If the stock pulls back, then I give back some of the profits that I've already made, not taking, hopefully, unless it's a complete and utter disaster, any sort of real loss. And I can always also hit out of the position after hours if I need to.
Mm-hmm.
So coming into those, I want to know what the options market is pricing in as far as the move will be for the stock. And obviously that's also more art than science, because it doesn't have to move. Like, for example, I think Microsoft was pricing in $11.50 and it went up significantly more than $11.50. So that can absolutely happen. But it's a great gauge of thinking about risk on what this stock can potentially do. And I actually, from a risk perspective, I actually like to be extremely conservative and assume that there's a potential that the thing can move double what the options market is pricing in.
Okay.
So if Microsoft was pricing in $11.50 into the report, don't be surprised if that thing moves $23 after hours, and like a crazy, huge beat or huge miss or some,
Right.
situation actually occurring.
Okay.
And for Google, it was $5.50. So I think Google closed around 104 yesterday. So I came in long into the report. I put some bids out in front of $100 in case it sold off, which would be, $4 from where it closed, but kind of $5 from where it opened. I
Mm-hmm.
wanted to stay above that $100 kind of psychological number. So going into the report, I put some small bids out in front of $100, and I put a bunch of offers out in front of like 109 and 110 for Google. Google reports it has a very quick initial downtick,
Mm-hmm.
very quick, like maybe a buck or so, not low enough to fill any of my bids, and then starts rocketing higher as the market begins to digest the news a little bit further. So I was able to get some great sales at about 109 and 110 in the stock. And then as it pulled back, I kind of continued to buy back that stock and kind of trade the name for most of the rest of the afternoon. I think I might have even sold a little bit of stock at like 7:45 p.m. Eastern last night, right before the after hours trading was going to end. And then I continued to trade it throughout the day today. The reports are really interesting. Microsoft is the one that really exploded, and
Mm-hmm.
they pretty much beat across the board. Cloud was solid, so the market's taken notice of that. I actually thought that the Google report was the more interesting one, because there was a couple key things in there. One was the ad spending beat
Mm-hmm.
expectations, and it didn't really show too much of a comparable decline from a year ago,
Yeah.
when everyone's expecting us to be in this huge advertising recession right now.
Mm-hmm.
And so I think it was very telling that Google was able to beat expectations on the ad spend. I thought that was going to end up being really important for the stock. Stock actually ended up not trading great today.
Mm-hmm.
But I was also wondering about what the other repercussions could be for Meta, which just reported today, for Snap, which I think maybe reports tomorrow, but I'm not 100%
Mm-hmm.
sure.
Okay.
Any of those more advertising complex stocks. And at first I was like, wow, this is so bullish that Google was able to beat. But thinking about it a little bit more, and even as we see the Meta numbers come out, which are also really solid beat across the board, Meta's trading up pretty nicely.
Yeah.
I can't help but still be a little bit nervous about like the smaller companies of the Snaps of the world, because I think if you're an advertiser, the last places that you're going to pull back your ad spend from are going to be Google search and
Google.
Facebook.
Yeah.
It's going to be the last thing that if you're cutting back, you're going to cut back in Duolingo ad spend and Snap ad spend. You're not really going to cut back in Google, YouTube, or which is obviously owned by Google, or Facebook right away. So
Mm-hmm.
these big tech stock earnings reports are all like pretty excellent so far. Stocks are generally trading well off of it, but the rest of the market isn't trading great. We see that with the Russell, and I do still have some concern about some of these smaller and mid-cap companies as their reports come out.
All right, so you mentioned it. Let's talk about it. Meta reporting after the close today. The company reporting its first revenue increase in 4 quarters. And as you mentioned, beating across the board pretty solidly. And the Q2 forecast also came in higher than expected as well. So after hours right now, last time I checked, stock is up double digits. Walk us through how you would approach this stock in tomorrow's session. Even if you're not planning to play it yourself, if you were to give a trader a game plan on, this is how, if I were doing it, this is what I would do. Talk me through it.
Sure. So I got pretty caught up with Roku after hours today because I have a position in Roku and I traded it very actively between the time it reported and the time we started our conversation here. But Meta is absolutely one that I was also paying attention to when the numbers came out because it's got important repercussions for the rest of the market. I'm not surprised at all to see the Meta beats. I'm not surprised at all to see the stock up this much. I've been talking about it honestly ever since the last report. The last report back in February when it had a huge gap up to like $180. Now after hours, as we're talking, it's at 232. It's just had a beautiful continuation uptrend over the course of the last quarter since the last report. Facebook is doing everything right now. And I want so badly to hate on Mark Zuckerberg, but to give him credit, he recognized that the market does not like what he's doing with the metaverse, even as they've changed their name from Facebook to Meta. And he took action when the stock had a 75% drawdown from highs and was trading below $100. He took action to cut costs. And when you look at underneath the surface of this company, they are just an absolute cash flowing machine. And the only problem was that he was blowing billions and billions of dollars on this metaverse dream. So he recognizes that the stock is getting absolutely crushed. He pulls back on the spend. He creates operational efficiencies. The cash flow monster that is Instagram and Facebook comes back in line, and the stock really continues. And I think that as I talk about operational efficiencies, this is and I don't want to get too off topic. This is a really big theme that's going on right now with these tech companies, with these big tech companies in particular. And in some ways, it actually started with Twitter. Another thing that I really want to hate on is Elon Musk with Twitter. I mean, he took a $45 billion purchase that he made, and right now it's probably worth $4 billion. So that's not a great job. But one thing that I think that a lot of these other tech companies took note of is Elon came in and fired like 85% of the employees, and Twitter still runs. It still works. Like I don't spend a lot of time on Twitter. That's not my social media of choice. But if I do pop on there, it looks the same to me more or less as it ever did. So you got all these other big tech companies like, wow, this guy just fired 85% of his employees, and the company seems to be operating properly. Everybody else is doing that. And not to get off the topic on Meta, and I know I haven't still directly answered your question, but there was one really key phrase from the Microsoft earnings report that really stood out to me as the stock was kind of exploding. And the key phrase was, I wrote it down, the March quarter results exceeded expectations driven by focused execution. And when you're in an earnings report, or if you ever listen to them, there's just a whole lot of like kind of mumbo jumbo that just gets kind of spilled by the executives in the report. And this almost kind of sounds like that to me. But if you actually think about it, I think it's actually a very meaningful statement that results exceeded expectations driven by focused execution. What does focused execution mean? It means operational efficiencies. And that's what all of these companies across the board are doing. And that's why I think that in some ways, this downturn in the economy, this huge sell-off that all of these tech companies that just said Microsoft had gone down, not Microsoft, Meta had gone down like 75% from highs. It was really an opportunity for them to trim the fat, to focus on their actual businesses, to streamline things, and probably become more profitable than ever. So you have that going on. Meta's ripping higher here after the earnings report. I'm not surprised to see it. Now, to directly answer your question, how would I look to trade it tomorrow if I look to trade it tomorrow? I always want to first see what the after hours levels are that are created. So people ask me about after hours levels a lot. And for most stocks, most of the time, they don't matter. Because most of the time there's not enough volume that's occurring for it to matter. But when you look at a big tech company like Meta, which I've got it up on one of my screens here, the first 5-minute candle as the report hit, the stock did over 2 million shares of trading in that 5-minute candle, is more than any in the regular session. The levels that get created on that degree of volume after hours tend to still be really important the next day. So I'll start, tomorrow morning by making note of what these important after hours levels are. It looks like out of the corner of my eye, 235 has acted as some resistance off of the report. You've got a pivot high, somewhere around that area. Maybe you can find some support around 230 on a pullback. It looks like it's trying to create a pivot right now at around 231.63. So I'll start by looking at those levels. I'll write them down. There'll be spots I'm paying attention to during hours tomorrow. And then I also want to see on a stock like this, it's going to gap up huge. It's up, 12% after hours. That's from yesterday's closing price, but it's up, 12+% after hours. That's going to open up very extended tomorrow morning. I usually like on these really big gaps to be patient in the very beginning of the day and just allow some natural price discovery to occur as the market begins to kind of satisfy the overbought conditions of it. It was, somewhat similar with Microsoft today, where you had to wait for Microsoft to range out for 50 minutes. It went directly sideways, which is actually building on a bull flag, until 10:20 a.m. Eastern. Finally, the ADMA catches up to that base of price action, and then it begins to break out. It begins to go, and you get an intraday, $5 move approximately when it breaks out of that consolidation, goes from 295 to almost $300. But you need to be patient enough to wait that 50 minutes. If you just jumped in the first second in that big of a gap, very easy to get yourself kind of chopped around. You don't know how much risk that you need to give it. So that's how I would look at Meta tomorrow. Pay attention to these after hours levels that are developing, and then be a little bit patient off the open, let some price discovery occur, and then you can look to get involved once you have a better understanding of the picture.
Okay. So you mentioned this, but your kind of most active earnings trade today is Roku. So you were waiting for that earnings report to come out after the close, came out after the close, and as you said, you've been trading it after hours ahead of our conversation here. You've been actively in this stock throughout the year this year. So talk me through your strategy for this one.
Yeah, I mean, I've been trading Roku really actively, I think, since sometime at the end of last year, or maybe it was, maybe it was the beginning of this year. Somewhere, I think after it bottomed around $40, is when I started to get involved in it. Roku is actually a really funny one for me because anybody who's been on my team for long enough knows that there was a period of time where I despised this company. I thought it made no sense. And as a matter of fact, Roku short is one of my worst trades that I've ever had. It was back in 2019. I got kind of run over and a big squeeze that the stock happened when I was short it. And back in 2019, the thesis on Roku for me was that the company just made absolutely no sense. It was trading at an insane valuation, and any other company should be able to come in and build a TV operating system and compete with it. Google should be able to do it. Amazon should be able to do it. Apple should be able to do it. And it just didn't make any sense. I fast forward to 2022, 2023, and my thesis and my thought process on Roku has entirely changed. For whatever reason, these other companies have not, in my opinion, from my user experience, built out good operating systems. Google has can't remember what it's called right now, and I used to have one.
I'll say personally, I have a Roku TV and I have a couple Fire Sticks on my other TVs from Amazon, and I much prefer my Roku TV. Works way better.
It's just a better product. So I've had the Amazon Fire Stick. I've had the Google Chromecast. That's what it's called. My parents have a Samsung TV, so I'm familiar with the Samsung operating system. They're all clunky.
I have it.
They're all clunky. They're not good. Roku's simple. I don't understand how no one else did it. But at this point now, 3-4 years later, they've got a moat for themselves. They've got the TVs. They've got people who are just used to it. So I think that the opportunity for one of these other companies to really come in and build that out is kind of gone now. And Roku is kind of taken over. And then the other thing is, I think it's a buyout candidate. And I'm almost surprised that no one's coming in and bought it out yet. At first, I thought it made sense that Netflix would come in and buy them, kind of own the rails type of situation. You can always have yourself, your app be the number one app on Roku, and Roku is the, most used operating system. And now I still think that's a possibility. I also think Walmart's a possibility. They have a partnership with Walmart where Walmart is, I think, exclusively selling their TVs. They're starting to build TVs together. So I think it might make sense at a certain point that maybe Walmart takes a look at buying out Roku, building out the Roku TV, having that Roku operating system, maybe getting into original content. And from an advertising perspective, and we've spoken a decent amount about advertising today, I turn on Roku, and that top right spot where they're advertising a show is like one of the best ad spots I feel like you could almost have. And I like to think or almost joke around that I'm immune to advertising. I don't I don't see something and then go and buy the stuff. But I tell you, I log into Roku and I see that they're advertising some program on the top right, and I'm like, oh man, I don't have Paramount Plus. That show looks interesting.
Yeah, that's happened to me. Now I have all the streaming services because of it.
Right? Exactly. So I'm interested in the stock. I still think it's a buyout candidate. I have got some valuation concerns when it's in the 70s and $80 kind of range, but it's one that has paid me pretty well over the course of this calendar year. I'm trading it. I'm continuing to stick with it. They just beat on their numbers across the board also, and on their guidance after hours. Stock's not reacting great to it. It's kind of trading right around where it traded all day, but I guess it could have been worse.
Yeah, it could have been worse. I'm sure Meta's, kind of taking everyone's attention after the close today. So just a reminder for everyone who's here live, I see you all here live. I can see that number, and I've only gotten one question so far. I have plenty more questions for Derrick, but I want to talk about what you guys want to talk about. So don't be scared. There's no question that's too simple. Derrick can talk about, beginner trading advice, specific stocks, his strategies around specific things. Anything you want to know, submit those questions. Okay, to wrap up our earnings conversation here, and then we'll talk a little bit about the economy and the Fed, and then we'll go to those questions, so submit them. Amazon is still coming tomorrow. That's kind of like the bookend for these big tech earnings tomorrow afternoon. In your positions disclosure, everyone can see you're long Amazon. What are you focusing on for that report? Do you plan to hold the trade before earnings? Are you going to kind of what you did with Google? Talk to me about it.
Yeah, so my game plan for Amazon is going to be the same as it was for Google. I have no idea how the stock is going to perform. I have no idea what the numbers are going to look like. I have some concerns that they haven't been able to create the same degree of operational efficiencies that we were just discussing that Meta and Microsoft have been executing on.
They've been mute on the whole layoff. They're like the one company that's not doing the big layoffs that everyone else did.
They announced AWS layoffs today.
Right.
Which is
but
always
that's
interesting.
The first. Everyone else, Meta's 21,000 into layoffs at this point. And Amazon hasn't
I don't know the employee Amazon numbers offhand. There has been a couple of layoff announcements, but on a percentage of the employees, it's been nothing compared to what the other companies have done. It's a little bit interesting that they announced the AWS layoffs the day before the report, and that always, and I've never seen any correlation to how a company ends up doing when they do that, but I always find it really interesting, why are you making major company announcements the day before your earnings report? Why not just wait for the report at that point? But we'll see what happens with it. It's also trading up after hours right now as a secondary probably to Meta. But for me, it's the same game plan as Google. I've been involved in both of them pretty consistently to the long side since last November, when you had the market itself bottom in October of last year, but then you had big tech kind of get hit last and get really smoked in November of last year. And that's when a lot of these stocks were kind of making lows or near their lows. So I've been trading Amazon to the long side pretty consistently since it was in the mid 80s. It's at 106.50 right now after hours. So I've got an okay profit cushion in it. It's the same game plan. I feel like I have a win-win situation in it. I will find out from my team in the ProDesk virtual trading floor, from Patrick specifically, what the market is pricing in from an options perspective. And then I'm just going to do the exact same thing I did with Google. If it's closing here tomorrow at 106.50 and they're pricing in a $5 move, let's just say, I'll have some bids out to add to my position a little bit, $5 down. I'll have some offers out to, loosen up on that position and book some profit, probably $5 up as just an example. So that's kind of what I'm planning on doing, but I have zero expectations on what this is going to look like and how the stock is going to react.
Yeah. Okay, so on top of this really big earnings week, we are coming up on some big economic data over the next couple of days. First estimate of Q1 GDP growth comes out tomorrow morning, and then the Fed's preferred inflation gauge comes out Friday morning. As a trader, how do you approach pre-market economic releases like this?
Sure. So if it's going to be if I'm expecting a really big reaction, like we've gotten on some of those CPI days, and this is really the only number where I've been implementing the strategy. I kind of do the same thing that I just described I'm doing with Amazon and Google earnings with the entire market on those big number days when I think that the entire market could have a really big move. So I find out what the S&P is pricing in on its move. I figure out, what percentage up or down that is, how that could correlate to every stock that I'm involved in, including, the additional beta of the stock. So it could be a bigger move, percentage wise than what the S&P is going to do. And I'll look at that area to potentially buy some stock on a down move or sell it on the up move. For these numbers, I don't know if it's going to be a big enough of a reaction necessarily. It's going to be important for sure, especially as we got the Fed in May. But I don't know if it's going to be a big enough of a reaction for me to actually implement that strategy. So I might not trade it. I still have to manage the open positions I'm in. I have swing positions every night. I haven't gone home flat in probably over 5 years. So I will have positions into those numbers. I'll have to manage it if the market moves up or down. One of the things that I love to do, just broadly speaking, when it comes to any news event, is I like to see where the market started from off of the initial reaction. So, let's just make some easy round numbers. Let's say that the market started at $100, whatever this market is, right?
Yeah.
The market started at $100, number comes out, and the market starts trading up. And it started at $100. So I paid attention to that $100 to see if the news ever gets negated. So the initial reaction is higher. While the market's trading above $100, while the market is viewing this as a positive event, I would rather be long than short. That's just the simple thought process. If it ever comes back below $100, well, that means that the market is not only interpreting it negatively, potentially, but every single person that just bought off of the initial upside reaction when it initially shot up above $100, every single person that just bought there is now out of the money. Yeah. And what do people do when they're out of the money? They tend to do one of a couple of things. They manage their risk and sell and get out of their positions. That's what a good, responsible trader does. Or they hope and pray that the stock, please come back to my price so I can just get out for break even. That's called unlimited risk for zero reward. It's the opposite of what a solid professional trader should do. Right. But now I know it's coming back below $100. The market doesn't like this event, doesn't like whatever this news is, and every single person that just bought is out of the money. So now I would much rather be short than long. So I keep the strategy pretty simple like that, just paying attention to where that starting price was. If you're above it, you'd rather be long than short. If you're below it, you'd rather be short than long.
Cool. Great. So my questions, I got mixed up. The Conference Board's Consumer Confidence Index came out yesterday, and that showed Americans are bracing for a recession. The spending shifts are already happening. Less people said they're planning to purchase large appliances. Less people said they were planning vacations over the next 6 months. This is what the Fed wants to see. They want to see people pulling back on the discretionary spending to get inflation down, but the consumer inflation expectations are still at 6.2% a year from now. That's higher than the Fed's own expectations for inflation, and something the Fed chair has highlighted as a problem. They see a real big issue. If we have these sticky consumer inflation expectations, it's not good for the economy and the recovery of the economy after a recession. Plus, we have that impending recession. It's not really a question of if at this point, it's when. So with all of that, the topic of stagflation continues to come up. Are you worried about stagflation, getting more worried about stagflation at this point in the economy?
No, I'm honestly not.
Okay.
I'm really not worried about it. So it's an interesting environment right now, and what you described almost seems like a bit of a self-fulfilling prophecy.
Mm-hmm.
If enough consumers are expecting a recession and tighten their belt enough on their spending, then you will get a recession, right?
Mm-hmm.
Because then they're not going to be spending anymore.
It's true.
Um, but I think that also does the Fed's job for them and
Mm-hmm.
further brings down inflation. So
Okay.
people are going to be spending less. Inflation is going to come down. Obviously, there are some concerns about energy moving up, but energy is always in a little bit of a universe of its own.
Yeah.
So I think that inflation is going to continue to come down. I think it's going to be a little bit of a long road, but I'm more in line with the numbers that the Fed has published than the
Mm-hmm.
consumer sentiment survey or whatever it is actually saying that the average Joe out there is expecting.
Okay.
So I think that the Fed is expecting that we're going to dissipate down to 3.5% maybe by the end of this year, and then
Mm-hmm.
we'll get down to 2% sometime in 2025, something
Yeah.
like that. So it's gonna be a long road, and I've said it from the beginning. It's a trend lower. And what is a
Right.
trend? A trend's a pattern of lower highs and lower lows. You're going to get bounces in inflation
Mm-hmm.
overall on the way down. But we've
Mm-hmm.
had steady declines now since June, July last year, whenever somewhere around there, I forget
Yeah,
exactly
the
which month
peak.
it was where we
Mm-hmm.
peaked.
Mm-hmm.
And what's going to end up happening pretty soon, as we're almost in May, is the annualized basis numbers, the annualized average there, those June, July numbers when we were peaked, they're going to start rolling off. So
Right.
I
Those
think that
base
the
effects of
inflation,
higher inflation versus still high
right?
inflation, but not as high as a year ago.
Yeah,
Yeah.
you're still having inflation, but that number's going to work its way down, and consumers are probably going to spend a little bit less. But I mean, the American consumer loves to spend, so don't underestimate that.
Yeah.
Um, it's going to be really interesting the back half of this year because we're going to be dealing with a situation where earnings are going to continue to decline, but
Mm-hmm.
we'll also be dealing with moderating interest rates and a little bit more of a friendly Federal Reserve, I think is what's
Mm-hmm.
going to happen.
Yeah.
I think, and we'll see what Powell says next week. I think this is going to be
Yeah.
the last hike. I do still
Yeah.
think higher for longer. I do still think
Mm-hmm.
that that's going to be on the table until inflation comes down, unless we go into a deep recession. But
Mm-hmm.
it's going to be an interesting battle in the back half of this year between declining earnings, but a Fed that's no longer hiking, and
Mm-hmm.
the market trying to figure out what an appropriate PE valuation is as those earnings come down. And then, the only other thing I would really say about that is that the market's forward looking. So,
Yeah.
if the market thinks that a recession is going to come, it's pricing that into the equity market now.
Right.
So I'm not, I'm generally bullish on the market. I do think that the highest probability is that we actually get a continuation of this range that we've been in since last May for the market for a further period of time as we work through everything that I just discussed. But
Yeah.
I'm definitely not a big bear on the market. And then when you look at some of these earnings reports that just came out, I mean, one thing we didn't even talk about, Google's going to be buying back $70 billion
Oh
of their
yeah.
stock over the course of the next year. I mean,
Yeah. That's a company
when
that sees their stock going higher in the next year for sure.
they're
Yeah.
doing everything they can to keep an underlying bid on that stock.
Mm-hmm.
So I'm not overly concerned about the market. I do think we still have a little bit of a difficult road ahead. I'm definitely not concerned about stagflation because I think if the recession comes, and we probably will, I mean, I would argue that we already had a recession in 2022 because I learned back when I studied economics at NYU that a recession is two declining quarters in a row of
Yeah.
GDP, and we had that in 2022. But
Mm-hmm.
some magical board somewhere decided that we're not going to call that one a recession. I
Yeah.
would already argue we had a mild recession. I would not be surprised to see another period where we get 2 quarters in a row of declining GDP, maybe Q4 this year, Q1 next year. That technically
Okay.
puts us again in another recession.
Mm-hmm.
But not all recessions are created equal. You're going to talk about a
Yeah.
recession where people spend a little bit less, but everybody still has a job. If that's the type of
Right.
recession that's coming in, I'll take it. So
Mm-hmm.
if that, in my brain, I've got a mild recession on the horizon that the market's probably already priced in conjunction with an inflation picture that I do think is going to continue to improve, and that mild recession will even help it. So I'm not overly concerned about stagflation. I don't think that what we're looking at is a repeat of the 1970s, and I
Mm-hmm.
still do believe in the power of innovation and globalization, that we pulled back away from globalization a little bit as a deflationary force on global markets broadly. So
Mm-hmm.
we're certainly not going to stop innovating. I mean, just look at what's going on with the AI craze right now. That
Yeah.
in and of itself is deflationary.
Mm-hmm.
So yeah, it's gonna be interesting.
Totally interesting. Okay, real quick before we get to audience questions, everyone who has a question, submit it now so I can ask them. I have a few lined up for you, Derrick, but we want more. Okay, so you mentioned the Fed. The meeting is next Wednesday. We're a week away from the meeting. 75%-ish of traders are agreeing that they think the Fed's going to do what they said they're going to do, one more rate hike, 25 basis points. That's what the Fed has said. I tend to believe that the Fed will do what they say unless it's, a major emergency. What are you focused on for this meeting? Obviously, like the rate hike's kind of a given. So are you reading the statement and seeing what changes? Are you listening to the chairman's press conference? What is your focus as a trader as we approach the Fed meeting?
Right. So the Fed fund futures over the course of the last couple of days since FRC reported has actually provided a declining probability of this 25 basis point hike
Yeah, I
even
didn't check
occurring
it. I checked it this morning.
in
I haven't
May.
checked it in the last 20 minutes. So it changes all day.
It changes
So,
every 15 minutes.
yeah.
Exactly.
So,
The Fed fund futures have been out of control.
yeah.
But last I saw was somewhere around the close, and it looks like a 75% probability
Yeah.
that's going to happen. In my
75.7.
brain, it's in my brain, it's 100% probability that
Mm-hmm.
that's going to happen. And maybe I'm wrong, but thus far, the Fed over the course of the last year and a half has done every single hike exactly as they said they were going to do it before they went into it. Are they
Yep.
all of a sudden going to change on this one? I don't think so. So I think we get the 25 basis point hike. The real key is going to be the language that comes around it. And that's what I'm really paying attention to. I'm of the thought process that this is it.
Mm-hmm.
That I think the Fed is looking at the data and they think that there's been enough hikes plus some natural tightening that's just coming from these banking crises. I think that's the plural, right?
Crises.
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 Um,
Yeah.
so there's been some natural tightening of credit that's come from that as well.
Yeah.
I think that they're going to look to pause, but that language is going to be so key if they
Yeah.
kind of more or less officially announce the pause
Yeah.
or
Because
not.
last time I think the language was they took out the further heightening as necessary and they changed it to like will be data dependent basically will determine if any more is needed after this. So yeah, I would agree on my own personal if I was going to tell someone what I think the Fed's going to do. Yeah, it's the changing of the language to okay, we're pretty much done unless something like crazy happens. But we're not
Right.
cutting. We're not penciling in any cuts until 2024.
Right. Yep.
Yep.
That's exactly what I think. And I think they're going to keep it there. And we
Yeah.
had discussed last time that the market was pricing in some ridiculous amount of cuts in the back half of the year. And
Yeah.
now that's kind of faded away exactly like you and I expected, Greta.
Yeah. I mean, if you just read what the Fed says, they typically just do what they say they're going to do.
Exactly.
Yeah. Okay, so let's get to some audience questions. Our first question comes from Daniela, and she asked, what are your expectations for the dollar? And do you have a trading strategy around it? This has been a really big focus for a lot of people in recent weeks, the weakness or the strength of the dollar. So what are your thoughts?
Sure. And there's been so much chatter about the dollar over the course of the year 2023 when it really hasn't done too much this year, actually.
Yeah.
It's kind of been relatively range bound. You had that big sell-off that started in like October of last year, which was the same time when the market bottomed. And that sell-off ended at the beginning of this year, January, February, and there was a little bit of a bounce off of it. But I think right now we're trading more or less in the midpoint of the range that we've been in for the entirety of the year. I think we saw Stanley Druckenmiller come out and say that he's got a really big bearish bet on, I think, someone needs to fact check me. I think he came out and said that he has more conviction on dollar deterioration right now than any bet that he's had in a while, or I don't remember specifically what that language was, but I'm pretty sure I saw that headline come across. And, Druck is definitely someone that I've got a lot of respect for as a fund manager. So it's interesting to see that he is saying
he
that.
said, I just looked it up for you. He said he's shorting the dollar after missing last year's rally and says it will keep falling due to interest rate cuts and a rise in non-dollar trade agreements.
Right.
He said, one area I'm comfortable is I'm short the US dollar. Currency trends tend to run for 2 or 3 years. Had a long run higher.
Yeah. Big move up on the dollar. I remember going to Europe in September of last year, and I timed that trip perfectly because I got a lot of bang for my buck over there when the dollar was at its peak. It was great. We pulled back pretty big from then. So I'm gonna let the technicals kind of dictate it to me. We're in this range here over the course of this year. See how the range breaks. Druckenmiller is someone I have a lot of respect for, and his thought process makes sense to me to some degree. But I also am not big on the chatter of the dollar no longer being the world's reserve currency, at least not anytime soon. And there has been a lot of chatter about it. Even what you just read with Druckenmiller's statement seemed to imply that there's just going to be more and more transactions that are not dollar denominated, and that's part of the short thesis there. I mean, I don't know what other currency you're going to do them in. Are you going to do them in the Chinese yuan? The yuan's basically still pegged to the dollar, so you might as well still be doing it to the dollar, unless you just want to be making, a statement by doing it in a non-dollar denominated, oil transaction or something like that. And we've seen other countries like Ghana has come out, and they're, trying to do oil for gold, like almost barter style transactions instead of using the US dollar. But they only did that because the dollar got so strong to begin with. So if anything, if the dollar weakens out, it makes a country like that
go back to the dollar.
Go back to using the dollar. That's exactly right. So, we'll see how it plays out. I don't have a strong big picture thesis for you on direction. I think that Druckenmiller's thesis is interesting, and it's something that you should read and pay attention to. I'm going to pay attention to the technicals to see if the range breaks. And I think the most important thing for me, because I'm not a currency trader, I'm an equity trader, and I do look at the dollar basically every day because I'm an equity trader, is understanding the effects that the dollar move has on the equity market. That a rising dollar creates more of a tightening impulse, that a weakening dollar, loosens things up a little bit, enables the market to be able to move up. That's the big thing that you want to pay attention to. And, we managed to be able to export some of our inflation to the rest of the world by having that strong dollar. And now it's come back down as our inflation is deteriorating. It just kind of makes logical sense.
Okay. Our next question comes from Chris, and he asked you, how do you choose what to trade?
Great question. So I have a universe of, 50 stocks that I look at and I go back to very, very regularly because I just really like how they trade. And I can talk about those parameters in a second. And I also really pay attention to what's in play that day. So what's in play, meaning what had news, what's got pre-market volume, and whatever is in play, whatever's got that pre-market volume because of that event creates potential trading opportunity. So I might have a universe of 50 stocks that I go back to very regularly, that I look at almost every single day. But then some other company that I have hardly ever even heard of has some news event in the morning that gets me involved in it and kind of gets me trading it. So I kind of combine those two things. I like a specific profile of a stock as far as price and liquidity and volatility, ideally, if I'm going to be involved in it. So I do, from a trading perspective, prefer to be involved in these tech type stocks because they've got the higher beta, they've got the better movements. I don't love trading a Procter and Gamble or a Coca-Cola because the movements just tend not to be worth it. I'll sometimes make an exception to that if it's like an earnings day, like Coke, Pepsi. They just reported earnings this week, last week, and there were pretty big movements off of that, where that can create opportunity because it's an event that occurred. But
Yeah.
otherwise, I want something that moves. Ideally, like to trade stocks that are priced between like $10 and $150. It's kind of broad, but that's my sweet spot. If you start getting above 100, $150, that kind of area, the spreads just kind of get a little bit too wide. I don't like trading stocks with wide spreads. I don't. It's more difficult to get good fills. So I like those more liquid, tighter spread stocks that are going to be moving, but can be anywhere from $10 to $150. And I also like taking bigger tier sizes. I don't want to have, like I love Chipotle, and Chipotle just crushed it yesterday, up 13% after hours. But I'm looking at a stock that traded above $2,000 today. I don't even type it up during the day because the spread's going to be so wide. What am I going to do? I'm going to buy up 100 shares of Chipotle and try to manage the position. I would much rather have, several thousand of a I don't know, $100 stock or a $50 stock than a very small tier size of a spready $2,000 stock. There's just much more I can do from a game planning perspective. Yeah. So I have kind of a profile and a universe of stocks I go back to very regularly. I'm very regularly trading these, big cap tech stocks, Apple, Amazon, Google. And Amazon and Google, by the way, I almost never traded them until they did those reverse splits. I was so happy when they did those reverse splits because it put them on my radar.
Yeah. Because they were like
these...
Chipotle, but those
exactly
$2,000, $3,000 stocks, you can't get a good
very rarely
good
I would trade it because of that.
Yeah.
Yep. So yeah, that's probably the answer to the question.
Okay, great. Everyone who is here live, I still see quite a few of you here. So this is kind of my last call for questions as we approach our time. I have some more to ask you here, Derrick, but just everyone who's watching, when I looked through the registration list today, I saw lots of new names that I haven't seen before, which is great. Don't be scared though to ask questions. Safe space here to talk about trading, anything you want to learn from Derrick. And he's a great teacher. So our next question comes from David, and he asked how you manage profits when this market is littered with short squeezes, and how do you determine the difference between a breakout and short covering?
Sure. So first question on managing profits. You have to have a preset game plan in for your trade before you get into it. That game plan is two-sided. The game plan includes what you're doing if that position goes against you when you're in it, on how you're going to manage risk. And the other side of it is how you're planning on managing reward if that trade works out for you. And then I'm a big believer in whatever game plan that you created for yourself, you should follow through with it to the letter. Don't change it mid-play. It's very easy to have your bad psychology mess with a game plan, and then that turns a winner into a loser or just negatively impacts the profitability of the trade. So you start by creating the game plan. And then the game plan will vary a little bit based on the type of trade that you're involved in and the market environment that you're in. So we've been in a market environment that's been very volatile but range bound. So that tends to mean that you can get some good follow through from the volatility, but like really big technical market breakouts have not really been working very well over the course of like the last year. So in this type of environment, I am much more likely to be taking profit incrementally on a larger percentage of my position, and then look to potentially rebuy that stock back at lower prices and kind of create the cash flow difference. It's a lot of what I do, and that can benefit in a range bound volatile market. So it's been a big focus of for me over the course of this year. And I've been doing a little bit less of the trailing, and I love trailing, by the way. I have trailing rules in place, very specific for my trades for when I'm with the trend. I think that trailing a position is a great way for reward maximization. But in this market environment that we're in, compare now to 2019. 2019, the market basically went up all year, and the biggest pullback on the entire year was like 1.5%. Like seriously, like I feel like traders forgot that, as opposed to this year where we move 1.5% like every day. It seems like in 2022 was even worse, right? In 2019, you are much better off having a reward maximization game plan that invoked trailing on the way up as opposed to trimming on the way up.
Mm-hmm.
trailing and raising your stop loss based on a set of rules over and over and over and over again, and you could just get really big gains off of that.
Mm-hmm.
In this market environment, we don't have, it's not 2019, right? We've got a ton of volatility. We don't have trend. Maybe this market breaks out, has not yet. So
Mm-hmm.
you're much better off having a reward game plan in place that maximizes the market environment, which
Mm-hmm.
means booking profit more readily, meaning, everyone likes that common term, trim and trail on the way up. This
Yeah.
market's more about trimming and a little bit less about trailing. And what I like to do is trim and then rebuy, and then trim and rebuy if I can, meaning
Mm-hmm.
the stock has a really big extension move. I want to trim into that. If it price corrects back down, I can take that stock back. So I'm taking back my original risk, not getting even heavier, taking my stock back and kind of
Mm-hmm.
keeping the P&L difference.
Hmm.
And that's worked great in this environment.
Yeah. And that's you adjusting to a market environment that we're in versus using strategies that worked for you in, 3 years ago that don't necessarily apply to now. Okay, our next question comes from Andrew, and he asked, when you are considering holding a new position overnight, I know you like to have profits in the trade before you swing it. How do you determine how much profit is appropriate? And are there additional general guidelines you look at when making the decision to initiate a swing trade?
Sure. So for keeping a position overnight, and it goes back to even when we were talking about earnings earlier and holding position into earnings, I like to do it from what I call a win-win positioning.
Mm-hmm. Okay.
So I put this trade on today, and whenever I'm trading, I'm almost always trading in the direction of how I like the daily chart. So assume that my trade works out really well. My daily chart's also on my side. I look at how much I'm up in the position. And if I have an appropriate cushion to take overnight risk, then I'll do it. And I'll see if I can get bigger reward from the daily chart. The
Mm-hmm.
longer that I've been in the trading business, and this isn't to say that I don't day trade, I do day trade. But the
Mm-hmm.
longer that I've been in the business, I have found that pure day trading is reward limiting. If I've got a position in my favor and it's worked great, and I've sold 75% of that position throughout the day, and the
Mm-hmm.
position is closing 3% in my favor, and I've booked a bunch of additional profit, why not keep that position overnight to see if I can get now a daily chart move off of it? What's
Mm-hmm.
the worst that happens? Worst that could happen is that there's bad news overnight, stock specific bad news, or bad news that affects the entire market.
Mm-hmm.
Everything gaps down the next day. Maybe the entire market, really big bad gap down 2%, and my
Mm-hmm.
stock gaps down 2.5%. But guess what? I was 3% in the money, and that doesn't even
Mm-hmm.
include what I booked already. So I'm giving back open profit to potentially make even more money. That's what I love to do. In the past, I've had something that I've called my 1% rule.
Mm-hmm.
And the 1% rule should not be called a 1% rule. I need to rebrand it. It's the 1% guideline. And the 1% guideline was always, I want to be at least 1% in the money on the position in order to keep it overnight.
Mm-hmm.
And then again, the entire market gaps down 1% tomorrow. My stock gaps down 1% tomorrow. All I'm doing is I'm giving back open profit. I'm in a win-win situation. 2022, with all the volatility we had last year in the bear market, certainly proved that for many positions in certain markets, especially if you're in a more volatile market, 1% may not be enough. So you have to have an understanding of the type of stock that you're in. How does this move on a typical day? How big could this thing gap?
Mm-hmm.
Maybe the whole market could gap down 3% tomorrow, and a 1% cushion is not enough.
Mm-hmm.
So the bottom line is I want to be at least 1% in the money, and 1% may not be enough. But I do like to keep those positions overnight when I'm in that win-win situation for further reward maximization. It's the only way that you can, from my experience, really be able to get like a 100x winner plus on your risk.
Yeah. Okay. So we have surpassed an hour of our event here. I could talk to you all day, but I know you have things to get to in your personal life, and everyone else also does after work as well. So I'm going to wrap up here. Thank you, everyone, for joining us for this edition of Conversations with a Pro Trader. You heard Derrick mention him once or twice in here. Patrick. Pat is his counterpart in the T3 Live's virtual trading floor, the Pro Desk virtual trading floor that Derrick runs. And Pat will be back with me next week. Next Wednesday at 5 p.m. Eastern, I am putting a link in the chat right now for the next event. You can register for that now and join me and Pat to talk about the Fed. Next Wednesday is the Fed. So we'll have lots to talk about, I think, next week. And Derrick will be back in a month from now. So make sure to come back for that. Thanks again for joining me today, Derrick.
Thanks, Greta. Appreciate it.
Yep. Have a good night.
See ya.